installment of GTM Training Shorts, presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what is a Section 481A adjustment? Listen to Luke Wisnowski, Senior Manager, as he explains.
Thank you, Frank. The following example illustrates the need for Section 481A. In this example, Jones Company has historically been a cash basis taxpayer. In 2024, it filed a method change to become an accrual basis taxpayer. At the end of 2023, the company had outstanding accounts receivable of $200,000 and outstanding accounts payable of $100,000. Jones will file a cash basis return for 2023 and will not recognize the accrued income and will not deduct expenses not yet paid. Jones will then file a 2024 accrual basis tax return, and it will not recognize the $200,000 of income that would have been recognizable in a prior year. It will also not take a deduction for expenses that were recognizable in a prior year. If the returns were filed this way and there was no adjustment made, the $200,000 of income would never be recognized, and the $100,000 of expenses would never be deducted. Section 481A adjustments solve this problem. A 481A adjustment is the cumulative difference between present and proposed methods as of the beginning of the year of change. If the adjustment increases taxable income, it is referred to as a positive adjustment. Generally speaking, a positive adjustment is spread over 4 years beginning in the year of change. An exception applies if the adjustment is less than $50,000 or an eligible acquisition transaction has occurred. In this case, the taxpayer can elect to recognize in the year of change versus spreading. If the adjustment decreases taxable income, it is referred to as a negative adjustment. A negative adjustment is taken entirely in 1 year. In our Jones Company example, the 481A adjustment would be a positive adjustment of $100,000, which represents the $200,000 of revenue minus the $100,000 of expenses. Jones will then recognize this positive adjustment over 4 years beginning in 2024, as illustrated in the table below.
For more information on why and how we file accounting method changes, check out our Corporate Tax Fundamentals 2 program, scan the QR code, or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.